Your mortgage rate, your car loan, and the health of your retirement portfolio aren't just random numbers chosen by your bank. They are directed by a quiet $145 trillion machine that most people never look at, the bond market. If you want to understand how money actually works in the real world, you have to understand bonds. At its core, a bond is simple. It is a loan. When a government, a city, or a company needs money, they bypass the bank and borrow directly from investors. You hand over a fixed amount, called the principal. In return, they promise two things: regular interest payments, known as the coupon, and your full principal back on a specific date called maturity. But there is one golden rule that governs this entire ecosystem. When interest rates rise, the price of existing bonds falls. If you hold a bond paying 3% and the government starts issuing new ones at 5%, your bond becomes less valuable to anyone else. To sell it, you have to drop your price. This inverse relationship is why the bond market has a massive, invisible hand over your daily life, starting with housing. Banks price mortgages by looking directly at the 10-year U.S. Treasury yield and adding roughly 2 percentage points to cover the risk. When the 10-year Treasury yield moves up by just 1 percentage point, a completely routine occurrence, it can add hundreds of dollars to a home buyer's monthly payment, costing them nearly $100,000 extra over the life of a standard 30-year mortgage. The bond market effectively hands out massive bills without ever sending an invoice. For generations, conventional financial wisdom told savers to move their money into bonds as they aged. The classic 60-40 portfolio used bonds as a safety belt to protect wealth when stocks fell. But in 2022, when the Federal Reserve raised interest rates at the fastest pace in 40 years, that safety belt failed. Because rising rates are poison to both stocks and bonds simultaneously, the broad bond market suffered its worst year in modern history, leaving conservative retirement portfolios completely unprotected. The severity of that damage comes down to a metric called duration, which measures a bond fund's sensitivity to rate changes. A fund with a duration of 6 loses roughly 6% of its value for every 1% interest rates rise. Unlike individual bonds that you can hold to maturity to get your principal back, bond funds never mature. They are repriced daily, meaning those paper losses become very real. The bond market also acts as the ultimate economic warning system through the yield curve, which plots interest rates across different loan lengths. Normally, the curve slopes upward because locking your money away for 30 years carries a higher risk than locking it away for 3 months. But occasionally, the curve inverts, meaning short-term yields pay more than long-term ones. An inverted yield curve has correctly predicted every single U.S. recession for the last 70 years. Ultimately, ignoring the bond market means leaving your own money exposed. Right now, standard savings accounts pay next to nothing, while short-term Treasury bills offer significantly higher, risk-free yields. Understanding bonds isn't a complex hobby reserved for Wall Street elites. It is the fundamental machinery of the global economy, and learning how it ticks is the first real step to master your financial future.